Hey, how's it going? This is Patrick at Public Company Community, and today we've got a pretty awesome course set up here. We're going to be talking about the budgeting process in general. We're going to talk about reporting budget to actuals, preliminary basis. We're going to talk about whether you need to have budgeting software like Host Analytics or Adaptive Planning, or whether Excel is going to work for what you need it to do. And then we're also going to talk about the true budget to actual reporting process and the forecast to actual reporting process and what that exactly looks like at a publicly traded company. So let's go ahead and get started. All right, so let's talk about the budgeting timeline. Any good budgeting process is going to start off with having a good timeline, and so that you know when things need to be done and everyone knows what their deadlines are. I've got a really good example of just a sample timeline that you can use out in the course docs. Looks like this. The first step in the timeline is build out the department budget templates. Now, if you're using Excel, I'd recommend that you take a look at one of my other courses that's talking about building out the budget templates. If you use software, you still want to go through, let's say it's Host Analytics or Adaptive Insights, you want to make sure you go through your permissions and have that all set up before you even distribute the files to the department heads. And the next step is setting the budget assumptions. So the budget assumptions, here's a few common ones. Are we trying to really tighten down the finances? Are we status quo? Or are we trying to expand and we can kind of loosen the reins a little bit on the spend? Or are we introducing any new product lines? Are we stopping any product lines? Are we opening, closing, relocating any facilities? Other companies, just specific assumptions that you might have. People will need to know the timing of when these big ticket items are happening so that they can plan in their budgets accordingly. So the next step in our process is to send the templates out to the department heads. One thing that you really need to be careful of is you need to be very cognizant of the payroll information that's contained in these budget templates. Now, if you're using Host Analytics or Adaptive Insights, there are specific permissions that you set for the different people that can view the budgets, and you can make payroll data visible or invisible to certain people, and then they can still see all of the other costs, just not the payroll information. If you're using Excel, you really can't do that. So you need to really double or triple check that all of the recipients that are getting this information are actually allowed to see payroll data. If there are individuals that are not allowed to see payroll data, then you need to go through and delete any payroll data out of it. Just be very careful with this step. There's really no room for errors on this. With the templates that you provide to the department heads, you need to also include all of those assumptions that we decided on earlier with the CFO and CEO, and then try to keep those assumptions as concise as possible. A lot of times email recipients don't read the entire text of the email, so just use bullets with the assumptions. Make sure it's something that people are going to actually read it. Also, on this first round, give people a deadline. People really need deadlines so they know how long they have to put things together. A good general deadline might be 2 weeks for this first pass, and that gives the budget heads enough time to talk with their subordinates and ensure that they're capturing all of their costs in their first pass of their budget file. Now, even though we gave them 2 weeks, one thing that you want to keep in mind is sometimes other people have more important projects that are going on that are company critical projects, and they're just not going to have time to do their budgets in those first 2 weeks. And so I always allow for at least an extra week to give people time to complete their files, just in case they're not going to be able to get them done in those first 2 weeks. I never want to give people my true deadline of exactly when I'm going to need it, because there's always going to be people that are going to have it to me a little bit later than that. Your next step is going to be to review the returned budgets. Now, what I'm doing is I'm going through all of the returned files and I'm looking for double counts in numbers. So this would be something where it's recorded in one department and then maybe a department head didn't know that another department was recording that exact same cost. That's somewhat common in this first pass, and then possibly amounts that are inconsistent with the prior year. So I'll literally run the GL detail for the entire year prior, or in really the year that we're currently in, right? Because we're doing this in September, October timeframe. I'll run the detail, see how the different vendors and costs are trending for each department, for each general ledger account, and I'll make sure that if there's a cost that's been fairly consistent for the first 9 months of the current year, I want to make sure that it's being budgeted for next year. And if it's not, there should be a good reason for why it's not being budgeted for. And then also I'm looking for items that are just inconsistent with the assumptions that we decided on. And then also, if you're using Excel, this one you need to be extra careful with, is make sure there's no formula errors. What happens is that oftentimes you can send out these budget spreadsheets and then people will add rows in places that will mess up the totals, or they can add columns, or they can delete totals. So you need to check all of those formulas if you're using Excel. Now, if you're using Host or Adaptive, it's really not an issue to check formulas as much. Now, as I'm working through all of these issues, I'm reaching out to the different department heads and I'm talking with them all. And every revision that I make to these files, I need to make sure that the department heads know what's being changed. Department heads really do not want to see me just unilaterally changing their budget. And I don't want to, because then I'm essentially taking ownership over their budget. They could take a hands-off approach and just say, well, the budget manager went in and changed all those numbers. I didn't agree to those changes. And so I always want to make sure that all changes are being run past the actual budget heads as well. And again, when we're working with these files, make sure you're really careful with the payroll information and you know who can and cannot see payroll data. And during this process, when I'm reviewing these budget files, I personally like to sit down face to face with the department heads and throw the budget file up on the screen, on a TV screen or a projector, so that we can see it, and just really go line by line and discuss all of the larger items that are in there to make sure that everything is accurate. So as the budget manager, once you've met with all the department heads and you've done all of your review of the budget files, now you're ready for the other finance or accounting individuals to start taking a look at the budget roll-up. Now, the involvement of the various individuals in the finance and accounting function, it's going to vary very widely from company to company. And it's just really based on management styles for each of the individuals. Some managers are really hands-off, and some want to get all the way into the details and see every single number. You just need to use some judgment. And what I like to do in these types of cases where I'm trying to predict what other people want to see is I just stop and think what level of involvement each individual is going to want, and then I talk with them directly and ask them ahead of time and figure out what level of involvement they're going to want. So the next step is the CFO or CEO sign-off and or CEO CFO. And through the various meetings and discussions, once the CFO gives the go-ahead, provide the budget to the CEO for his or her approval. Now, once the CEO and CFO are signed off on the budgets, it's now time to start getting the board decks ready and getting these budgets in a presentable manner for the board to actually approve them. Now, this is often when things start to get pretty interesting from a budget manager standpoint. Now, there are going to be a lot of big ticket meetings that you're going to have to run, and you just have an excellent chance during this process to get a lot of exposure with some of the really sharp business leaders at your organization. And it's one note is it's often easy to get intimidated by some of these meetings. And here's just a few tips that I've got for you for running these meetings as the budget manager or director of budgeting. First, know your numbers before you go into these meetings. Look at your files, have an idea of what you want to talk about, and then really have a very specific list. If it's going to be a high-level meeting with, let's say, CFO, CEO, make sure you have a very specific list of the big-ticket items that you want to talk about and make sure that you get resolved and that everyone is in agreement on these certain cost spends. Now, with that said, you need to play it by ear, and you just have to figure out what they want to talk about during the meeting and what they want to focus on. You may have this huge agenda that you didn't share it necessarily, this large agenda, but you had a written out agenda of what you wanted to go over, and you may end up throwing the whole thing out because people don't want to talk about what you thought they were going to want to talk about. So you just need to be adaptive and know your numbers again, and stay present. Don't worry about the past or the future. Just focus on the exact right now, current moment. And then also keep the conversation on topic. What happens a lot of times, especially it's a factor of how many people are in the room, is that the conversation will just start straying. And while it's good to be friendly and cordial with everyone also has very tight deadlines, and they have a lot of meetings, and we need to make sure that we cover everything that we need to cover. And the last thing we want to do is waste people's time. So if it starts getting off on a tangent, feel free to take charge and pull it back onto topic. The next step in the process is, if you're doing the consolidated roll-up in Excel, you build all these linked tables, and we went through this in one of the previous classes, where you build linked tables for a PowerPoint presentation for the board, and this is what you'll give to the board for them to review and actually approve. Now on the slide, you'll see some of the more common tables that you'll put in a board package for budget approval. So we've got sales and gross margin by month, by department, or by class, cash burn and ending cash balance by month, P&L. Now you can do an internal category P&L, so it's like sales, cost of goods sold, payroll, office costs, things like that. And then you can also dice it up by department and just say total cost by department, so we can see which departments really are driving the big numbers. And then also P&L by major lines on the SEC filings. This is important if you're looking at it from kind of an investor viewpoint. Then you can see what we expect our sales and cost of goods sold, what we expect our actual SEC reported income statement to look like next year. And then CapEx by department with major additions tick marked or detailed out. And then it's also good to have a headcount sheet so we can see what the changes in headcount are proposed. And with this board approval, one thing to note, this is typically required in most Sarbanes-Oxley processes. And in my experience, a formal board approval, either in the unanimous written consent or more frequently in an actual face-to-face meeting, there will typically be an actual resolution that approves the board, approves the budget. So that the board has enough time to actually review these files and make an educated decision on them, it's a really good idea, it's actually necessary that you provide the budget or the PowerPoint deck containing the budget at least a week before the board is set to approve it. Now, generally at publicly traded companies, like I said, there is a SOX control. Once the board has formally approved the budget, now it's time to actually upload the budget into either your general ledger package or into your budgeting software like Adaptive Insights or Host Analytics. So let's take a second and talk about whether your company needs to be using a formal budgeting software like Adaptive Insights or Host Analytics. Those are the two big ones. Or whether you think you can get away with using just Microsoft Excel. So some of the pros of using actual budgeting software is that the budget reports are way easier to run. So for example, a company-wide headcount report by employees takes forever if you're trying to just use Excel spreadsheets, because you need to go into every single department file and accumulate them all. But it's really just a few clicks away if you're using budgeting software. So getting reports out of the budgeting software and getting the reports that you actually need is going to be way easier versus using Excel. Another thing is with Excel, you're going to have formula errors that you need to be very careful of. And so it's much less likely to have these types of formula errors if you're using actual software. Another thing, especially as you have more people involved in the process, and at bigger organizations, you're going to have more people, is that budgeting software is much more collaborative. So if you have multiple people working on the same budget at the same time, maybe the manufacturing budget has 5 to 7 different people that need to provide the numbers for 5 to 7 different components, then it's going to be much easier for those people to all collaborate on the same budget at the same time. Whereas if it was in Excel, they would have to maybe set up a shared Excel spreadsheet, or there's a few ways around it, but it's much more manageable if you have budgeting software. And then also, if you're doing a monthly forecasting or a flex budget, what a lot of companies call it, it gets to be almost unmanageable to do such a budget if you're not using software. So if you try to do that out of Excel, it starts to get really challenging when you're trying to drop actuals in, and it really gets challenging. Now, with that said, I've seen huge companies use Excel for budgeting, so it's very common for even large publicly traded companies, not large, but even medium-sized publicly traded companies or small ones, to use Excel for budgeting. So here's some of the benefits of using Excel versus the software, is you're going to get a lot more flexibility in the design of the cash flow reporting. That's one of the reports that's very challenging for the software. When I say software, I mean host or adaptive, for them to handle, is getting that cash flow forecasting. If that's something that's critical, you're likely going to have to do a lot of your cash flow forecasting in Excel anyways. So then you get to this position where you're constantly updating the software, right? But then you have to spit the numbers out of the software into Excel anyways and manipulate it in Excel. And so that's one thing. Now, when formulas don't work in Excel, all of us are very familiar with how to use Excel. I would imagine if you're watching this that you're pretty close to an Excel expert. And so when formulas don't work in Excel, it's so much easier to troubleshoot them, right? It's what you see is what you get. But when you're talking about budgeting software, when things don't balance in budgeting software, you've got all these dimensions and projects and the way that you're excluding things, and it can get really challenging figuring out why something's not balancing when you're using budgeting software. And then, of course, it's free, right? Excel is free to use. We all already have Microsoft Office on our computers, whereas software, bottom line, you're going to be spending $10,000 to $15,000 in the year of setup, and then another $10,000 to $15,000 as an annual recurring charge. And that's bottom line. That's for very few users and a relatively simple small company. And then lastly, Excel does not require any training. I guess it kind of goes without saying, but with budgeting software, you're going to, at least that first year, you're going to need to sit down with everyone that's actually going to be getting into the budgeting software. You're going to need to teach them how to use the software. And it can be pretty time consuming for you and for them. So that first year of implementing budgeting software, it's going to be somewhat challenging. Now, with that said, it ends up being a really big decision for your organization on which way you go, whether you go with host or you go with adaptive or you just keep it in Excel. Now, a lot of companies think that just by default, since they're publicly traded, they need to have budgeting software. For the really large companies, it's absolutely true. You need to have the budgeting software. It gets way too complicated to manage all of the different departments and the permissions in Excel. But for some of the smaller companies or even medium-sized companies, don't fully discount Excel yet. It's got some benefits that you can get out of it, and it's certainly doable to run a budgeting process in Excel. All right, so let's skip ahead a little bit here. We've done all of this hard work to make the budgets. We got them approved by the board, and now we're in, let's say, January of next year. And we need to see how the actuals are comparing to the budgeted amounts. I mean, after all, this is really the whole point of it. There's no point in making a budget unless we're going to actually check to make sure that we're following it during the year. So to do this, we need to make sure that the actual costs that are coming through on the general ledger are posting to the same department in the same general ledger accounts that we budgeted them in. So to ensure that everything's in the correct department, one thing that I've found is that department managers are very sensitive to having actual costs from other departments hitting their department. So from an accounting standpoint, we may think, well, who cares if $50 charge is hitting the wrong department? We might say it's not material. Well, to the majority of the department heads, they do care. And really for good reason. We want them to care. And for one thing, they're held responsible for the costs that are hitting their department. They often work really hard throughout the year to save money whenever they can. And they don't want to see their, even though maybe perceived, fiscal responsibility being just negated by accounting errors. So in addition to that, they start thinking, I know it's only $50, but what other costs are being jammed into my department? Now they may also start doubting just the competency of the finance team in general. So you need to remember, in their minds, finance, accounting, it's kind of the same thing. And whoever's providing them with the budget reports, which is likely you, is the person that's responsible for them being accurate. All right, and another way that we need to analyze the actual numbers is we need to ensure that the actual costs are posting to the same accounts that we budgeted the costs in. Now, this isn't going to be of great importance to the department heads. Oftentimes they don't care as much which general ledger account it's posted to, as long as it's in the correct department, but it ends up being of great importance to you, the budgeting manager. You need to make sure that all the actual costs are posted to the same accounts that we budgeted them in. And that's because when the actuals are posting to the wrong accounts, then your budget to actual work, which we'll get into, becomes difficult to impossible to perform. One way to make sure that everything is posting to the correct place is to get involved in the general ledger close process. Now, after all the accruals are in, but before the allocations are posted, it's a good idea to look at the file that we created previously in the previous lesson here and look at the trends in the various accounts to ensure that it's consistent with the current period and to ensure that it's consistent with where the costs are budgeted. So I'll literally go through row by row, and again, this is pivoted. If you missed the previous class, all it is the general ledger detail. This is for a sample company, pivoted by department, which in this case is design, and then by general ledger account, and then by vendor. Very critical that you're doing this step as part of the close process before the close is completed. And really just look at the trends and make sure that everything makes sense. So you've got payroll that's pretty consistent, and then you flip over to your approved budget file for this department for design and just see, okay, is it lining up correctly? Are we way off or way over or under on payroll? It should be fairly consistent. The fuel looks pretty consistent. We've got this negative here. That one would cause me some attention. I'd likely put a comment on there. Why negative? Where's the debit? And then you'll work with the general ledger team with this file and go through it with them, and you all will decide which items need to be fixed and which items are correct as they are. Now, this is a very common step in the close process at both large private companies or publicly traded companies. And even if you're at a small company, this is a great exercise to go through just to ensure everything's hitting the correct general ledger account in the correct department. Now, another step in the finance or budgeting process that is typically done at most publicly traded companies is what's called a forecast, or you can call it a flex budget. And what it is it's like redoing the budget every month. So the forecast is essentially redoing it for the remaining months in the current fiscal year, just based on feedback from the department heads. However, the forecast does not need board approval. Very rarely does it need board approval. But what does happen typically is that the CFO is going to take a look at it, or the controller, and then just provide just more of an informal approval of the forecast each month. Now, why do companies go through such significant amount of extra work? And the reason that the companies do this is that the annual budget becomes stale surprisingly quickly. Companies take on originally unplanned projects, spending starts trending higher or lower, and sales start trending higher or lower. Now, the way that this process works and what typically happens is that the finance team, so they'll run the budget to actuals after the close is completed, and they'll start comparing the actuals to budget and identifying some of the larger variances. So finance is then going to talk with the various department heads and determine if things are savings or overages or just timing related. So savings means that, let's say we budgeted something to cost $20,000, but the final invoice came in and the total charge was only $5,000, right? This would be $15,000 of savings. And we would not update the forecast for future periods, right? Because that period's already gone past. However, overages would be the opposite. And then timing variances would be the converse of both of those. So timing variances would be when we budgeted to spend, let's say, $20,000 in one month being analyzed, but then the costs actually hit in a later month. So in these cases, the finance team does need to move the costs in the forecast to the month that they expect the cost to hit. So during this process, the individual reaching out to the department heads, when they're going through the budget to actual process, they'll typically ask just a couple additional follow-up questions so they can update the forecast as well. And so it'll be things like, are there any other savings or overages that you know about for the remainder of the year? Open-ended questions like that. So companies, if you're not already doing this process, if you are contemplating implementing doing forecasting, you're going to need additional resources on the finance team. And then they're also going to need significant amount of support at the executive level, because it's a lot of burden placed on the department heads as well, because they now need to explain all of these different variances and they need to redo their budgets every single month. So it really needs to have executive approval all the way at the top. And the forecasting process becomes almost unmanageable if you're using spreadsheets and Excel files. You really need to seriously consider using like a Host or an Adaptive or several other budgeting softwares out there. You really need to strongly consider using one of those packages instead of Excel if you want to start doing forecasts or flex budgets. And then generally just the complexity of managing the forecast in Excel and the difficulty of generating the needed reports out of Excel. Just even out of a basic general ledger program, it's going to just really force companies to need to get budgeting software if they want to do forecasting. So forecasts can be done in a slightly different way, and I'll call this the alternative process. So I've seen companies that use the forecast process really more in a way to generate pre-close actual numbers. So it's really almost like the general ledger team is asked to close the books twice. So in these processes, they start about 3 days before the end of the month, and then the finance team is going to work with each of the department heads and the accounting team just to update all of the forecasts before the period even closes. So in these cases, the forecast will typically be completed a day or two before the period actually closes. And then that way, let's say the company is doing earning guidance, or the company needs to report out to venture capitalists that are owners of the company or the private equity firms, then the CFO can report that information that will be materially correct, hopefully, typically 5 to 10 days earlier than they would generally be reporting that information. The CFO doesn't need to wait until the final close is done. As you can imagine, this is a big process. This is not a free thing to do, right? You need additional resources at your organization to be able to manage the entire forecasting process. And also you need to make sure that everyone's on board with the additional workload that's going to hit them for both the department heads and the other people in the accounting department. The other thing that's kind of neat about this alternative forecasting process is that Then when you go to compare your forecast to your true actuals, when you actually close the books, any significant variances are going to stick out because there really shouldn't be any variances, any significant variances. And any significant variances that are still there are typically going to be the result of either an error in your actuals or an error in your forecast. Okay, so now let's fast forward a little bit. So the general ledger is officially closed. So after the close is done, the next step is to start on budget to actuals if you're the finance manager. And then also the forecast to actuals. So different companies place a different level of importance on comparing the actuals to budget versus comparing actuals to the forecast or the flex budget. Oftentimes the department heads earn bonuses based on staying in their budgets, but it's pretty rare that department heads will earn bonuses for staying on forecast because it's just an updated what we actually think is going to happen. Now also, oftentimes the department heads may not even know how they're tracking to their budgets, and they may need to decide to slow spend or delay projects if they're running over budgets. And a big thing here is that company culture and just the tone set by the CEO and the CFO are really going to dictate how important it is for department heads to not go over budget. Some companies use budget purely as a tool to forecast, and they just don't let their budgets influence whether money truly gets spent or not. Whereas other companies will stick to the budget very tightly and will prohibit department heads from spending over their budget. And then, of course, a lot of companies are somewhere in the middle of that. Now, this budget to actual and the forecast to actual, this gets completed at two different levels. It gets done at a departmental level, and then it can also be done at a consolidated level. So let's look at the consolidated level analysis. Now in this analysis, the finance and accounting team, they're going to compare budgets to actuals or to forecast to actuals for the month and for the year to date, or possibly for the quarter to date and the year to date. And then just based on the precision that they want to get to, they're going to go through and detail out the reasons for all of the different variances in the major revenue categories, the major cost of goods sold categories, and major expense categories. And then they're also going to go out and obtain explanations from the various individuals, whether it's from the finance people or from the accounting team or from the department heads themselves. Now, as a requirement to get continuing education for this course, we need to go through some review questions. So let's get started on those. First one, which of the following events occurs near the beginning of the budget development process? So is it A, the budgeting manager sets up the templates or establishes the permissions for each department? Is it B, the board approves the budget? Is it C, the external auditors approve the budget? Or is it D, the CFO approves the budget? So which event occurs near the beginning? All right, everyone have their answer? Let's look. So the answer is A, budget manager sets up the templates and establishes permissions for each department if they're using software. This is generally the very first thing that the budget manager is going to do, of course, after developing the timeline. Now, the board approves the budget. This isn't going to typically happen until the budget's actually done, so that would be near the end of the process. And then external auditors approve the budget. External auditors generally do not need to approve the budget, so that's not going to be even in the steps of the process. And then the CFO approves the budget. This typically does get done, but it's going to be later on in the process. All right, so let's look at number 2. Forecasting, this is fill in the blank. The forecasting process is generally, so is it A, not done at publicly traded companies? Is it B, performed each month by the finance team? Is it C, not very time consuming for the finance team? Or is it D, not good for predicting future costs? So why don't you all take a second to think of your answer. And it is B. So performed each month by the finance team. This, of course, is if the company does forecasts or flexible budgets, then it's done each month. Now, it's not done at a publicly traded company. That it is typically done at a publicly traded company, so that's why A is incorrect. So companies typically establish at least each year a budget. And then C, the forecasting process is generally very time consuming for everyone involved in it, whether it's the department heads providing information or whether it's the finance team gathering and collecting that information. And then D, the forecast is actually a really good way to have an updated projection of future costs at any given time. All right, so let's look at our final review question here. So it's fill in the blank. Generally, the blank approves the financial budget each year. So is it staff accountant, outside counsel, internal audit manager, or board of directors? So everyone take a moment to pick which answer you think is right. And it's D. Board of directors generally provides a formal authorization of the budget. So A is not correct. Staff accountant generally does not have authority level to approve the budget. B, the outside counsel is typically not involved in the budgeting process. And then C, the internal audit manager generally is not all that involved in the budgeting process and does not provide a formal approval of the financial budget. All right, so that's really it. I mean, man, we covered a ton in a pretty short period of time. So we talked about the budgeting process and setting it up initially. Then we talked about reporting out the budget to actuals and the forecast to actuals. And we talked about the forecast process and the flex budget. And then we also talked a little bit about whether you really need to have budgeting software like Host Analytics or Adaptive Insights, or whether you can get away with using Excel. So I hope you all found it to be a pretty good course. All right, so that's really it. Man, we covered a ton in a pretty short period of time. So here's what we went over. We talked about just the budgeting process in general. We talked about whether you need to spring for getting an actual budgeting software like Host Analytics or Adaptive Insights, or whether you can get away with just using Excel. We talked about the forecasting process, or some people call it the flex budget process. We talked about evaluating the budget to actuals on a preliminary basis before the close is even done. And then we also talked about the formal budget to actual analysis that's completed once the general ledger is completely closed. One thing that I would strongly encourage you all to get involved in is author an article or teach a course. With both of these, I will help you through every step of the way. And the coolest thing about it is that you get free CPE for doing it. So with that, join me on one of my other courses.